in the first 11 months of 2024, we didn't get the December numbers yet, but it's the third largest in this century. I think we're witnessing, I guess you could say, a Bretton Woods 3, a new world monetary order. I think it's centered more around commodity-based platforms rather than fiat currency-based. De-dollarization, of course, is no longer a fringe theory whatsoever, and it's driven by a lot of things, mostly the weaponization of the dollar, but also the Federal Reserve's rapid policy shifts as well. They cause concern. In crises, the Fed inject a tremendous amount of liquidity into the system through quantitative easing and suppress interest rates. We've seen that. And the byproduct, when inflation starts to rise, or the other side of the coin, is they reverse course and with sharp rate hikes, and you can see the disruption that's caused. And now they're kind of caught in the middle. I think we can see commodity trades and settlement shifts away from the dollar and local currencies and in gold, all certainly across the southern hemisphere. This erodes the demand for the dollar or the necessity to hold it. Facilitating trade settlement outside the dollar is really a big thing that I see increasing here in 2025 over things like mBridge and its successor BRICS Bridge, because what the BIS did to the BRICS, Bank of International Settlement did to the BRICS at the 12th hour, and they're meeting in Kazan pulling out of mBridge after 4 years of their innovation hub supporting it and helping develop it with China, Hong Kong, Thailand, the UAE, and then ultimately Saudi Arabia, saying at the 12th hour, we can't be involved with any countries that have sanctions like Russia, as if they just realized that R stood for Russia in the BRICS after 4 years of helping develop this program. It's espionage. To me, it's James Bond. It's right out of its Bond movie, and I think it will crystallize and reinforce the BRICS resolve. Regional trade agreements, obviously, we're seeing more of that. China buying corn, let's say, from Brazil, the second largest exporter of corn in the world, and soybeans, canceling the same time contracts with the U.S. and Australia, buying it from Brazil, paying for it in yuan, settling in their local currencies, settling any trade imbalances with gold. It's happening in real time. These are all accelerating. In the United States market, lots to talk about here too. And I'll just go over it and then you can ask me any questions you have. One thing that really caught my attention, Peter, was already it's been a volatile start to the year, right? You got this Trump euphoria. And that's a dangerous thing in this environment because it's ignoring the fundamentals that were just so bad just a few short weeks ago before he took the presidency. Last Tuesday was the largest volume in the history of the NASDAQ. 13.4 billion shares traded. But what caught my eye was that it was record trading in U.S. stocks under $1, valued at under $1. This is speculative mania when you're buying the penny stocks like this under $1. And it was the highest recorded day ever in trading stocks under $1. Interesting. At the same time, since Powell pivoted and lowered rates on the federal funds rate on the front end of the interest rate curve, we've seen 10-year yields shoot up, and this is the biggest ever move higher in interest rate yields post the first federal rate cut. So the Fed lowers rates on the front end, the 10-year shoots up the other way, the highest ever in history after a cut. And the 10-year, that's in the 10-year treasury yield after a cut. And it's never been like that, ever, which is a big deal. And that's the market's way of saying, no, we understand that you've chosen inflation over austerity. We will not hold any duration treasuries without a much higher yield. First of all, let's talk about gold accumulation. The central banks have doubled down their purchases in gold over the last several months. In November and December, or October and November, the last 2 months, I'm not sure if December came up yet, but their numbers were twice the 12-month moving average. One of the things that I find interesting is that China and Saudi Arabia have both been caught recently importing gold that they did not report to the IMF. They said that China said they stopped buying gold. They hadn't done that. In fact, there was an estimation that was just came out on several news sources saying that they said they bought 5 tons. Recently, they think it's 55 tons, 10 times underestimating what they said. The import-export numbers caught both Saudi Arabia and China importing gold through the UK and Switzerland. They never reported it to the IMF. Sorry, it was a mistake, more or less. And as we've talked about ad nauseum, China, when they buy gold through the People's Liberation Army, or when they buy gold that is not 999 pure, it's not reported to the IMF. And I'll get to that in a moment. When the proxy banks, the commercial banks, buy on behalf of the PBOC, it's not reported to the IMF. But when you talk about what China has been doing, they've been flying all around the world, buying doré and concentrate from the miners directly, disintermediating the marketplace. They're not telling the world how much they're buying. They're purposely being private, and they're purposely being opaque, and they are purposely not being transparent. Although they've been caught a few times, they're the largest producers, they're the largest importers, they are a net importer, they have an insatiable appetite for gold. It's just beginning. And so we can continue to talk about how much gold the central banks are buying, but it has not stopped. The IMF says that central bank gold holdings have gone up to 1.16 billion troy ounces, and growing. And they're the largest holders of gold on the planet. They understand this. The trend for this to continue, it's not stopping. When we talk about BRICS, you have, I guess I would call it a shadow supply chain, not just in gold, but also in silver. They're bypassing the traditional markets. They're buying doré and concentrate. In fact, 75% of all the industrial silver they're using now is coming from concentrate. It's a sludge that goes that the miners have, and they scoop up the sludge. They sell it for pennies on the dollar. China's paying double what the West will pay and refining it back in China. And so this is the second largest producer of silver in the world, a net importer, buying gold directly from the miners in South America to disintermediate the marketplace. No one has any idea how much they're buying. This is going to be the new trend. Because of what the West did, because of what BIS did, and in essence at the 12th hour embarrassed them and pulled out and called out Russia as someone that they could not be part of this new cross-border payment plan with, when it was developed in their innovation hub 4 years ago with these countries. It's criminal. So now everything that you see is going to be more and more and more opaque. We see 9 new countries that have joined as their partner country. They're not a full member, except one of them became a full member, and that's Indonesia, the largest holder of nickel in the world in the ground in Indonesia. Their president, Widodo, has called for an OPEC-style cartel of rare earth metals. Almost all of them are mined or found in the Eurasian continent. And this is something that, again, it's only going to get worse because 100% of rare earths are refined in China the last few years, and the majority of it are mined in these areas. But you have Belarus, Bolivia, Indonesia, who is now a full member, Kazakhstan, Cuba, Malaysia, Thailand, Uganda, Uzbekistan. As it is right now, they hold 15% of the world's gold reserves, 30% of the world's land mass, 40% of the world's population, and 54% of global GDP. Not to mention, they control the majority of the strategic routes on sea and many on land. They're growing. And when you look at the foreign reserves that these countries hold, the dollar share of foreign reserves has dropped to 57.4, the lowest since 1994. So they're continuing to shed dollars, they're shedding treasuries, and they are buying gold, which has doubled the performance since 2000. It's up 180% over treasuries since 2008, and it has no counterparty risk. And that's something that's going to continue. Let's see if I have anything else here. I think, here's some more. Again, we're seeing this massive shift away and settlement by these BRICS countries outside the dollar, and they're using, which will be BRICS Bridge and BRICS Pay. BRICS Pay is a system that will allow cross-border payment very seamlessly for consumers, for B2B. And BRICS Bridge will use the unit settlement token. They're going to use it, which is a 40% gold-backed token agreed upon in principle. According to Dilma Rousseff, the head of the BRICS New Development Bank, the former president of Brazil, we have agreed in principle to the new BRICS settlement, and it won't be a common currency. They will all trade with one another in local currencies, as we see increasing settlement in local currencies, but any net settlement balance will be settled in gold, and they will do it through the deliverable mechanism of the bridge. And they're talking a lot about tokenizing gold to have that trade across BRICS Pay and across BRICS Bridge. All of these things will massively undercut the demand and the need to hold U.S. dollars and the need to hold U.S. Treasuries. So that's happening as well too. This is all happening fast. It's something that I think underestimating will be a very big mistake. And they wanted to assimilate into the Western system. They made it very clear. My guess is, when you talk about Trump saying we'll put on 100% tariffs, it's just more nonsense. Again, those are not tariffs. Those are sanctions masquerading as tariffs. Tariffs are put on to protect your manufacturing base, not to say if you don't do this or else. And it just makes me wonder sometimes, Peter, this is where my head starts to go into the fringe category. It makes me wonder, Trump is the ultimate, he's the master of the bankruptcy. He's a master of restructuring.